In this module, we shall study about company analysis. Efficient market hypothesis suggests that all the information relating to industry, economy or company is reflected in the prices of shares in an efficient market. The EIC analysis is the main activity in fundamental approach to security analysis. Thus, it is indispensable for an investor to go in detail study of all these analysis before investing. In this chapter, we will study about company analysis. The company analysis presupposes that the industry analysis and the economic analysis have already been made. So here we will discuss about the company specific factors like the number of years for which company has been working, quality of its management, firm's position in the market and various other factors. After studying this module, you would be able to know about the company analysis, learn the meaning of financial statement analysis, classification of ratios, learn the meaning of annual report. Now, we shall understand the concept of company analysis. Company analysis, as the name suggests, deal with the analysis of company. The aim of company analysis is to find out which is the most attractive company to invest in within an attractive industry. For this, investors collect and study lot of data about the company. But an investor should always keep in its mind that recent data are always more reliable than a long term before past data to be studied. The fundamental analyst is always very much interested in firm's financial statements. The actual value of a share depends upon the time and capacity of the firm to make its place among all firms. An investor must analyze the profitability, asset utilization, sales, debt proportion, etc. Many researchers and analysts recommend that the financial statements of a company must be analyzed carefully before investing in it. The financial statements of a company such as statement of profit and loss account, balance sheet, cash flow statement, notes to accounts, etc. must be analyzed in depth. Also, one should look for the strategy of company, its concern for people, etc. Company analysis helps to know the risk and return of individual shares. Let us now discuss the financial statement analysis. Financial statement analysis is an important step in company analysis. It is used to estimate the financial performance of the company. Many investors go for ratio analysis to know the potency and limitation of the companies. Different ratios measure different aspects of a company. Ratio analysis is the process of forming and understanding the numerical relationships based on financial statements. A ratio is a statistical standard that provides a measure of the relationship between two variables. This relationship can be expressed as a percent or as a quotient. Ratios can be of interest to owners, creditors and financial executives. Investors need mainly a foundation for estimating earning capability. Creditors are concerned primarily with liquidity and ability to pay interest and redeem loan within a specified period. Management is involved in developing logical tools that will measure cost, efficiency, liquidity and profitability with a view to make intelligent decisions. Moving on to the classification of ratios. Financial ratios can be classified into various categories. There are various kinds of ratios like liquidity ratio, solvency ratio, profitability ratio and some other ratios. Liquidity ratio. Liquidity ratio is used to extend the liquidity position of a firm. They are also called as a ratio indicating short-term solvency of a firm. There are two kinds of liquidity ratio, current ratio and asset test ratio. Liquidity ratio states a company's ability to repay short-term creditors out of its total cash. It is the result of dividing the total cash by short-term borrowings. It shows the number of times short-term liabilities are covered by cash. If the value is greater than 1, it means fully covered. The formula is the following. Liquidity ratio is equal to liquid assets upon short-term liabilities. First, current ratio. It is computed by dividing current assets by current liabilities. The ratio is usually an acceptable amount of short-term solvency as it indicates the extent to which the entitlements of short-term creditors are covered by assets that are likely to be converted into cash in a period corresponding to the maturity of the claims. Second, asset test ratio. It is also termed as quick ratio. It is resolved by dividing quick assets, that is cash, marketable investments and sundry debtors by current liabilities. This ratio gives no importance to inventory as it does not quickly get converted into cash. Next, turnover ratios. These are also called as efficiency ratios. They indicate how efficiently assets are being managed. They are found out by measuring the relationship between sales and different types of assets, current and non-current. The formula is receivable turnover ratio is equal to net receivable sales divided by average net receivables. A high ratio suggests either that a company activates on a cash basis or that its extension of credit and collection of accounts receivable is proficient, while a low ratio implies that the company is not making the timely collection of credit. There are 4 types of turnovers. First, voluntary. Voluntary is the type of turnover which arises when an employee voluntarily chooses to resign from the organization. Voluntary turnover could be the result of a more appealing job offer, staff conflict or lack of advancement opportunities. Next, involuntary. Involuntary, which arises when the employer makes the decision to release an employee and the employee against your will leave his or her position. Involuntary turnover could be a result of poor performance, staff conflict, etc. Next, functional. Functional, which occurs when a low performing employee leaves the organization. Functional turnover decreases the amount of paperwork that a company must file in order to rid itself of a low performing employee. Rather than having to go through the potentially difficult process of proving that an employee is inadequate, the company simply respects his or her decision to leave. Next, dysfunctional. The 4th type of turnover is dysfunctional, which occurs when a high performing employee leaves the organization. Dysfunctional turnover can be potentially costly to an organization and could be the result of a more appealing job offer or lack of opportunities in career advancement. Next, solvency ratio. These ratios are calculated to know whether a firm will be able to pay its debt in long term or not. Solvency ratios are calculated to know whether the company can meet its financial obligations or not. The solvency ratio defined as net assets plus net premium written. The solvency ratio is a measure of the risk an underwriter faces of claims that it cannot absorb. The amount of premium written is a better measure than the total amount insured because the level of premiums is linked to the likelihood of claims. Different countries use dissimilar methodologies to compute the solvency ratio and have different requirements. There are some other ratios also which are also used to analyze a company and its share price. These are: first, debt ratio. Debt ratio is a financial ratio that specifies the percentage of a company's assets that are provided via debt. It is the ratio of total debt, that is the amount of current liabilities and long-term liabilities and total assets. The amount of current assets, fixed assets and other assets such as goodwill. Debt ratio is equal to total debt upon total asset, or alternatively, debt ratio is equal to total liabilities upon total assets. Second, a going concern is a business that functions without the threat of liquidation for the predictable future, generally regarded as at least within 12 months. It implies for the business the basic declaration of intention to keep running its activities at least for the next year, which is a basic assumption to prepare financial statements considering the conceptual framework of the IFRS. Hence, the pronouncement of going concern means that the entity has neither the objective nor the need to liquidate materially the scale of its operations. Third, accounting liquidity. Accounting liquidity is a measure of the ability of a debtor to pay their debts as when they fall due. It is usually expressed as a ratio or a percentage of current liabilities. Liquidity is the ability to pay short-term obligations. Next, profitability ratios. Profitability ratio measure the effectiveness of management in the employment of business resources to earn profits. These ratios indicate the achievement of a business enterprise for a specific period of time. Profitability ratios are used by unevenly all the parties connected with the business. A strong productivity position ensures common stockholders a higher dividend income and appreciation in the value of the common stock in future. There are some other ratios also which are also used to analyze a company and its share price. These are earning to price ratio. This is calculated by allocating the EPS, earnings per share, by the market price of share. Next, dividend yield ratio. It is the ratio of DPS, that is dividend per share, and market price of share. Next, payout ratio. It is used to measure the portion of EPS given as dividend. It is calculated by dividing the DPS by EPS. Next, return on equity. The return on equity ROE ratio is similar to the ROA ratio in that it reports how effective company management is at generating profit with investors' capital. However, ROE is more particular than ROA because it pays no attention to the role that company liabilities play in producing profit. Next, gross profit margin. It measures the percentage of revenue that remains after a company covers its operating expenses, also identified as cost of goods sold (COGS). However, the GPM does not extend a company's overall profit as it ignores the general, selling and managerial expenses that don't directly relate to producing the revenue. To calculate the ratio, divide total sales by the COGS. Next, analyzing profitability ratios. Whenever you evaluate a company using profitability ratios, you need to understand the limitations. In most circumstances, the ratios provide limited understanding unless you analyze trends over a number of years and relate it to financial results of its competition. Let us now discuss about the annual reports. Investors also study and analyze annual reports of a company. They are very interested to know what is communicated by board of directors. Nowadays, investors are also becoming interested in corporate social responsibility disclosures and reporting by company. Annual reports give an idea about what company management is thinking and how firm will be taken further. They tell about company's business plans and performance targets. One can get a little idea about the trends for the future and scope for growth. First, timely compliance with legal requirements. A company which is very active in timely complying with the legal requirements is successful in building its good image. This also increases the value of shares of the company. A company which is actively calling meetings on time, filing returns and various reports meeting the required rules and regulations is valued more by investors and analysts. Next, other factors. There are various other factors like inventory with company, how much capacity is utilized, segment performance, employee welfare activities, companies concerned for environment, etc. that affect the company's share valuation. Other factors could be change in the business plan and strategy, mergers and acquisitions, joint ventures, etc. Company's environment, both internal and external, feasibility of survival and growth of the company. So, we have seen how and what is analyzed by investors about a company. Company analysis is the final analysis in the EIC analysis. The economic analysis deals with the prospects for growth of the company and its impact on the environment in which business operates. Industry analysis aids the investor in choosing the right industry to invest in. Once industry is decided, the investor wants to make a decision about a company whose shares he will buy. For this, he has to do company analysis. Company analysis take in hand the risk and return of individual shares, for which annual reports, public announcements, financial reports, etc. are used to study and reach at a decision. Let us now recapitulate what we have learned so far. Company analysis is the final analysis in the EIC analysis. Many researchers and analysts studies the variety of information about the company. It is assumed that a person doing company analysis has already done economic analysis and industry analysis. Company analysis can be done by studying financial statements. They make use of financial ratios such as liquidity ratio, solvency ratio, profitability ratio, efficiency ratio, price earnings ratio, etc. to get more information about it. Investors also study and analyze annual reports of a company. A company which is very active in timely complying with the legal requirements is successful in building its good image. A company which is continually filing returns and reports complying with the different but necessary rules and regulations is valued more by investors and analysts. Various other factors like change in the business plan and strategy, mergers and acquisitions, joint ventures, etc., company's environment, both internal and external, feasibility of survival and growth of the company. An investor has to make use of all such information wisely for a better and logical decision in choosing a company and investing in its shares.